Whole life insurance is a form of permanent insurance, meaning it covers the insured for the rest of their life and the coverage never runs out, unlike term insurance, which terminates at a certain point. In a standard whole life policy, the premium is paid for the rest of the insured's life, typically up to age 100, and the premium amount remains constant, for example, $2,000 a year forever. Limited pay life option. An alternative to the standard payment structure is limited pay life, which allows the consumer to limit the premium payment period, for example, to age 65, or for a period like 20, 30, or 40 years. Although the insured is still covered for life, the premium is much higher than a standard whole life policy because the payments are crunched into a shorter time frame. The insurance company can offer this because the higher premium increases the policy reserve, or cash surrender value, faster, which is then used to continue coverage after the payments stop. Policy reserve and cash surrender value. Permanent insurance, such as whole life, includes both insurance coverage and a money component known as the policy reserve or cash surrender value, CSV. The policyholder can access this cash value while they are still alive. One way to access the cash value is by cashing the policy in, where the client surrenders the policy and receives the entire cash value, for example, $50,000. The major drawback to cashing in is that it forfeits the policy, and the insurance coverage, for example, a $500,000 death benefit, is lost. Non-forfeiture options. Non-forfeiture options allow the client to access the money without forfeiting the policy. The insurance company allows the policyholder to borrow money up to about 90% of the policy's cash surrender value while the policy remains in force and premiums continue to be paid. Another non-forfeiture feature is the automatic premium loan, APL. If the customer fails to pay a premium, the insurance company will automatically take a loan from the cash surrender value, for example, $2,000 per year, to pay the premium and keep the policy in force. As a loan, it accrues interest, and the loan amount plus interest must be repaid, typically deducted from the death benefit upon the person's death. For clients who no longer want to pay premiums but wish to maintain coverage, there are two primary non-forfeiture options. The first is extended term insurance, where the cash value, for example, $50,000, is used as a single premium to buy term insurance equal to the original death benefit, for example, $500,000. The coverage is for the same amount but only for a limited period of time, for example, 12.5 years, because it is term insurance. If the insured dies after the term expires, there is no coverage. The second option is reduced paid-up insurance, where the cash value, for example, $50,000, is used as a single premium to buy a reduced amount of permanent insurance, for example, $250,000. The coverage is for a reduced face amount, but the insured is covered for the rest of their life with no further premiums due. Dividend payment options. Participating par policies can issue dividends, but clients should remember that dividend scales are not guaranteed and are subject to change. Clients choose how to receive their dividends from 5 different options, which can be remembered using the acronyms CAT and PP. The CAT options. The first 3 options are cash, accumulation, and term insurance. With the cash option, the dividend is issued directly to the client as a check or is electronically transferred. The accumulation option involves placing the dividend into an account, an accumulation fund, giving the client flexibility as the money can be saved, invested, withdrawn by the holder, or paid out along with the death benefit. With term insurance, the dividend is used to purchase the maximum amount of 1-year term insurance that the dividend will cover, providing the maximum possible death benefit for the dividend's value, but the policy expires after 1 year. The PP options. The last 2 options are premium reduction and paid-up additions. The premium reduction option helps the client save money by having the dividend applied to the policy's premium, meaning the client only pays the remaining difference for the premium. If the dividend grows large enough to cover the entire premium, the policy is considered to be in premium offset. With paid-up additions, PUAs, the dividend is used as a single premium to purchase additional insurance that replicates the original permanent policy. These additions are fully paid up, meaning no more premiums are owed, and they will not expire. The PUA increases the policy's death benefit and has its own cash surrender value, which grows over time, and the client can surrender the PUAs and use their cash surrender value to pay for future premiums on the original policy, which is another form of offset. Comparison of term and permanent insurance. Term insurance is a temporary policy that has an end date, while permanent insurance, such as whole life or universal life, lasts for the life of the insured. Term insurance premiums increase at every renewal, but permanent insurance premiums are level, remaining the same amount every month. Generally, term insurance is less expensive, whereas permanent insurance has higher premiums. Term insurance has no cash value, but permanent insurance generally includes a cash value component that is intended to grow over time. An exception to the cash value rule is the T100 policy, which is permanent but does not have a cash value. Term insurance is renewable and convertible to another policy, sometimes without medical evidence, but the features of renewability and convertibility are not applicable to permanent insurance since it already lasts for life. Term insurance is best for short-term insurance needs that have a known end date, such as covering a mortgage debt, child education, or court-mandated. Spousal support. Permanent insurance is for insurance needs that remain until death, such as estate planning, covering taxes on investments, inheritance, charitable giving, funeral expenses, or spousal support that is not part of a divorce situation. Term to age 100, T100 policy. Term to age 100, T100, is a type of permanent insurance that covers the insured for the rest of their life, up to age 100 and beyond. It is considered a hybrid between term and permanent insurance. T100 policies are stripped down and do not have a cash value or dividends. It offers permanent coverage for the rest of the insured's life with no expiry date. It's positioned as an option that's relatively inexpensive, similar to term but without the expiration date, making it a middle-of-the-road price product between term and more expensive permanent insurance like whole life or universal life. Premiums are paid up to age 100, though the coverage continues after that age, and the payout of the death benefit at age 100 varies by company. Primary use: estate liquidity. The most common use for T100 is to provide liquidity for an estate, which is especially relevant for older clients, for example, those in their 60s, 70s, and 80s, who have already accumulated investments in property. The need for liquidity arises because, in Canada, a person is deemed to have disposed of all worldly assets at fair market value the day before death, making any capital gains taxes, funeral expenses, and other debts immediately due. The principal residence is the only asset that generally escapes this issue, as other properties, like a cottage, are considered investments subject to tax implications. If the beneficiaries, for example, the children, do not have the cash to pay these taxes, they may be forced to sell off parts of the estate, for example, the cottage, to cover the costs. T100 is designed to prevent this by providing a tax-free payout to cover these final expenses. Joint last survivor. T100 is often set up as a joint last survivor, or joint last to die policy for a spouse and their partner. This structure takes advantage of the spousal rollover, which defers the tax implications until the second spouse dies. The insurance money is then paid out upon the second death to the named beneficiaries, who can use it to cover the now due taxes and other costs, ensuring the estate, for example, a cottage or portfolio, can be transferred to the next generation without being liquidated.